Look, most market participants enter the arena with a total gambler's mindset, treating the stock market like a casino, where they're just desperately chasing after the next hot tip. But true financial freedom, it isn't built on speculation, and it certainly isn't built on luck. It's built on a rigorous, systematic process. When you buy, you aren't just trading flashing symbols on a screen. You are actually acquiring equity in a real business. So today we're moving way beyond the basics to explore the professional framework of valuation, execution, and quantitative expectancy.
Welcome to today's explainer. Okay, let's dive into this. As this quote right here brilliantly highlights, treating your investments like a highly structured business is the very first, absolutely crucial step toward consistency. Think about it. Your overheads are just your losses and your fees, and your sales are your wins. Once you actually adopt this mindset, you stop gambling and you start architecting a reliable, repeatable system for growth.
All right, here's our architectural blueprint for today. 1. From speculation to system. 2. Advanced fundamental valuation. 3. Market structure and phases. 4. The mechanics of execution. And finally, number 5. Edge and risk management.
Let's kick things off with Section 1. Advanced fundamental valuation, the foundation.
You know, professional analysis always begins with the bottom line, but it definitely doesn't end there. A static snapshot like earnings per share, or EPS, only tells you the profit per share today. It's looking in the rearview mirror. To find true value, professionals look at the PEG ratio. This takes the traditional price-to-earnings ratio and adjusts it for expected future growth. This is the exact metric that reveals whether a high-flying, fast-growing tech stock is actually fairly valued, or if it's just completely caught up in market hype.
Furthermore, we absolutely have to distinguish between top-line revenue and free cash flow. Revenue is simply the total income from sales. Looks great on a press release, right? But free cash flow, that is the actual lifeblood of a mature company. It's the cold, hard cash remaining after every single expense and investment is paid off. It literally dictates a firm's true ability to issue dividends, perform share buybacks, or fund new acquisitions. It's the metric that proves if a business is truly thriving. When the pros evaluate a balance sheet, they aren't just trying to pick a winning lottery ticket. They are categorizing assets to strictly manage risk. You have to balance the rock-solid stability of blue chips with the mispricing of value stocks. You weigh cyclical assets, the ones that soar in a booming economy, against defensive pillars, like healthcare or utilities, that act as your armor during tough recessions. Knowing exactly what kind of engine you have under the hood of your portfolio is critical.
Let's move to part 2 and see how this all builds. Market structure and phases, the blueprint. So the market basically operates in trends, ranges, or just choppy indecision, and professionals strictly focus on those first two. In a trending market, we see very distinct cycles. Phase 1 is the run. That's the big extension in the direction of the trend. Then, phase 2 is the pullback. This is a momentary correction before the trend actually continues. Now, rookies constantly make the mistake of buying at the absolute peak of a run because of FOMO, fear of missing out. And what happens? They inevitably get stopped out during the completely natural pullback correction.
Which really begs the question, right? Where do professional investors actually enter a trade? I mean, if you shouldn't buy during the peak of the run and the pullback is just a momentary correction, how on earth do you find that optimal entry point amidst all these phases?
So the crucial point is you have to look left. The professional secret is waiting for the pullback to hit structural support zones. When a market is trending harmonically, previous resistance, which basically acted like a ceiling, often becomes the new support, acting like a floor. By patiently waiting for price to pull back to these horizontal or angular support zones, you align your entry perfectly with the path of least resistance.
And once price finally hits that support zone, professionals look for price deceleration as their ultimate confirmation. This looks like smaller and smaller candles or big wick rejections on a chart, like a high test or a shooting star candle. It's literally the visual story of a tug of war where the counter trend is finally running completely out of steam. That's your signal. That is the optimal moment to strike.
Moving right along to Section 3, the mechanics of execution, the plumbing.
Honestly, this is the exact phase where so many beginners completely fail, simply because they don't speak their broker's language. You can have the best fundamental analysis in the world and incredible chart reading skills, but if you fumble the execution, the whole system breaks down. You absolutely have to remember this vital reality. Every order is just an instruction, it is not a guarantee of price. In the modern stock market, matching buyers to sellers is done by automated systems at breakneck speeds.
Your big profit target? That might literally just be someone else's entry, and your stop loss might be their exit. It's all just raw supply and demand interacting in real time.
And this brilliantly illustrates the critical difference between the instructions you can actually give your broker. Limit orders are used when you want to enter when the price is better than current levels, like buying lower or selling higher. Stop orders, on the flip side, are used to enter when the price breaks a certain level, which confirms the momentum. Mastering these different types allows you to fully automate your trading discipline.
Here is an ironclad rule of professional execution for you. Before a single trade ever goes live, you must define these 3 exact points: your entry, your stop loss, and your target. Defining these strictly in advance prevents your emotional animal brain from taking over and making terrible, reactionary decisions when market volatility inevitably spikes.
All right, Section 4, Edge and Risk Management, the roof.
So we've laid the foundation, we've drawn the blueprint, and we've installed the plumbing. Now we need to install the protective roof. Let me state this cardinal rule as loudly and clearly as possible. A professional never, ever risks more than 1% of their total account on a single trade. You calculate this by looking at the pip gap between your entry and your stop loss. By limiting your risk to just 1%, you ensure that even a string of completely unavoidable losses won't blow up your account. It keeps you in the game long enough for your edge to actually play out.
Now, what's really interesting about this slide is that it brings us to the ultimate truth teller of a systematic business, the positive expectancy formula. You take 1 plus your average win divided by your average loss, multiply all of that by your strike rate, and subtract 1. If the end result is a positive number, congratulations, you have a mathematical edge. Numbers just do not lie. This formula proves beyond a shadow of a doubt whether your strategy is a precisely managed business or if you're just gambling masked as investing.
Which leads us to our final thought for today's explainer. I want you to look closely at your current approach to the markets and ask yourself, are you building a truly resilient architecture of alpha, or are you just gambling on your next hot tip? By applying structural valuation, precise phase analysis, and incredibly strict quantitative risk management, you can finally leave the casino mentality behind and start building lasting financial freedom. I really hope you found this explainer helpful in designing your own systematic approach to the markets.